Global agricultural markets operate on a massive, highly calibrated scale. But beneath the efficiency of modern extraction lies a delicate system, highly sensitive to even minor disruptions. Recently, that system fractured. Global wheat prices abruptly spiked, hitting trading levels that caught broad market participants off guard. This tracks global wheat prices over 3 years. We last saw volatility of this magnitude in 2022, following the Russia Ukraine war's outbreak. However, while that surge was a singular geopolitical event, the current action operates differently. We are watching three separate pressures hit the market simultaneously. What we are analyzing today is a compounding supply side shock. It is the result of regional conflict, severe domestic weather anomalies, and algorithmic market thresholds all aligning at exactly the right time. The first constraint on the market is physical logistics. Renewed escalations between Russia and Ukraine are directly threatening critical maritime choke points, putting millions of tons of seaborne agricultural trade at risk. At the same time, the United States is experiencing a domestic agronomic failure, removing a massive volume of projected supply from the global balance sheet. Finally, mathematical trading systems are detecting these physical deficits. As key thresholds break, automated capital flows in, accelerating the upward price action. Forecasting agricultural commodities into the late 2020s requires dropping single variable analysis. To understand where prices are heading next, we have to map exactly how these different forces interact. The Black Sea region houses the industrial infrastructure required to move massive quantities of grain. Recent escalations directly threaten these specific export terminals and silos. When these corridors are threatened, maritime insurers raise premiums or refuse coverage entirely, recreating the exact logistical bottlenecks that choked global supply in 2022. Ordinarily, a disruption in one region can be stabilized by another. The global market relies on secondary pillars, like the United States, to release surplus inventory and calm prices. But that buffer does not exist right now. Severe, localized droughts across North American growing regions have destroyed domestic yields before the harvest could begin. The localized climate data is severe enough that this year officially marks the lowest yielding U.S. wheat crop in 73 years. To put a 73-year low into perspective, you have to look back to an era of manual labor and mid-century farming techniques. Modern agronomy, with its advanced irrigation and genetically modified seeds, is specifically designed to prevent failures of this magnitude. Our entire domestic infrastructure, these massive concrete elevator complexes, was engineered to process and store immense annual surpluses, not sit empty during severe deficits. The simultaneous constriction of the world's primary export corridor and the failure of its critical secondary supplier leaves an undeniable physical vacuum. With tangible supply missing from the system, buyers are forced to pay a steep premium to secure what little is left. This dual-front physical shortage is precisely what translated directly onto the financial tape, driving the vertical price action we see today. Looking at this candlestick chart of wheat futures, we can map exactly how a physical deficit triggers a financial response. Market algorithms monitor specific mathematical price ceilings, known as resistance levels. The compounding reality of Black Sea tensions and a 73-year domestic crop failure applied enough continuous buying pressure to finally shatter that long-standing resistance. Once that specific line is crossed, algorithmic trading systems automatically execute buy orders. This rapid influx of volume turns a steady fundamental climb into an aggressive financial rally. While general traders were caught off guard by the sudden velocity of this move, specialists analyzing the underlying meteorological data were already positioned for it. Meteorological commodity analyst Jim Roemer has maintained a cautiously bullish position on wheat for the past month, tracking the exact convergence of these physical constraints. Roemer mapped the structural shift, providing the thesis to institutional clients via his climatologence and weather wealth newsletters weeks before the breakout occurred. A chart breakout rarely happens in a vacuum. The technical tape is often just the lagging financial symptom of underlying climatological and geopolitical realities that have already shifted. Geopolitics and algorithmic triggers explain the current price spike, but accurate institutional models must look past today's volatility and map the global supply matrix for 2026 and 2027. For long-term structural forecasting, the dominant variable is macroeconomic meteorology. specifically the impending cyclical patterns of El Nino. El Nino is driven by warming sea surface temperatures in the equatorial Pacific. As the ocean heats up, it forces a massive and systemic realignment of atmospheric moisture across the entire globe. This map shows how that realignment plays out. It creates a strict zero-sum game for crop development, driving torrential, yield-boosting rains into specific basins in the Americas, while simultaneously starving traditional growing regions in Australia and Southeast Asia of crucial moisture. This redistribution of rainfall forces analysts to recalculate global production capacity as the primary burden of supply shifts away from historical breadbaskets. To build an accurate forecast for 2026 and 2027, quantitative models must aggressively price in these localized El Nino impacts right now. Geopolitical disruptions create sharp, temporary volatility spikes, but these massive, multi-year climate cycles dictate the baseline floor price for the entire commodity class. The modern agricultural commodity market is highly complex. Relying on a single metric to evaluate price action is no longer viable. The current momentum requires acute stress on Black Sea logistics, compounding tightly with the worst domestic U.S. wheat crop in 7 decades. Only together do these physical pressures generate enough force to break established technical resistance levels, resulting in the aggressive price action we see today. While algorithmic trading will eventually settle and regional conflicts may stabilize, the fundamental environment supporting global agriculture is undergoing a structural transition. As Jim Roemer's forecasting demonstrated, a durable analytical edge requires marrying precise technical chart analysis with advanced long-range meteorological data. Looking ahead to 2026 and 2027, the ultimate driver of global wheat production and the resulting price action will not be negotiated in diplomatic war rooms. It will be dictated by the harsh physical realities of a shifting global climate.